Joining us now is the founder, the CEO and the chief investment strategist of Mainstay Capital Management, David Kudlow, with us. David, great to have you. We heard President Trump say in the press briefing earlier that he would love to see a big bang reopening of the economy, but realistically it could be more of a targeted, staggered reopening across parts of the country. Is this kind of a buy signal at this point, and a point where the bottoming out has started to wrap up, or would you really need to see more evidence from health authorities before you'd feel that confident?
Well, it's interesting. When we have been modeling this bear market and the eventual recovery, and we still look at this as an event-driven bear market, not a secular bear market. It could morph into a secular bear market, and that is if it goes on long enough, if employment and enough of the dislocations we've seen in the bond market, if we see credit become more of a problem. And there are those that already want to call it a secular bear market, something, much more catastrophic like 08, 09 and the financial crisis. We still consider it more in the event-driven bear market category that we recover from a lot more quickly, and the drawdown is much less severe. That said, we think we're still in the bottoming process, and there is more to go here. There is more volatility ahead of us. I think what has given investors a lot of confidence is, as I said, in our last segment here moments ago, is that we've seen improving data. I think on coronavirus at a quicker rate than maybe was expected, at least here in the U.S. And now we've had Dr. Fauci, who's widely respected in this country for his credibility in all infectious disease and the work that he's done, who said that the apex or the height of our in all of our flattening the curve efforts, that apex could be coming as early as a week, and that's probably earlier than a lot of people expected. That's given investors a lot of confidence. Now, do we get a second or third wave, as we spoke about earlier? Do we get, what is really the ultimate consequences in terms of the economic impact? Those economic numbers, first quarter earnings, second quarter earnings, that's yet to be determined. So I think it's early for investors that think that we have the all clear.
David, how does the price of oil factor into all of this? Because we have seen with oil prices, really commodities falling across the board. President Trump, at the moment in the White House, being asked about a potential oil cut here in the U.S., saying that the U.S. has already cut, that this is market-oriented, but of course a lot of expectations on what the U.S. will do as we get the OPEC Plus meeting. What does this do to asset prices?
Well, when we look at what oil was doing in March, it really exacerbated the problem. And when we look at, the lower quality bonds, we look at junk bonds, certainly exacerbated the problem in yield spreads and the problems in junk bonds because of what was happening in the energy complex, with oil falling to the lows that we saw at the same time that the stock market was falling to its lows. So that volatility in the oil market, I think, has only exacerbated the problem in the financial markets.
What about the volatility that we're seeing in gold? Because it continues to be under pressure despite the fact that yields are near zero now.
Yeah, it's been interesting. We've still favored gold as a relative safe haven in this environment. Zero coupon treasuries have been a very good safe haven. Treasuries across the board, except for some pricing dislocations as the Fed was coming in and other central banks, and trying to work out that plumbing to make sure that, first of all, the central bank here, the Federal Reserve, trying to work out and make sure that the plumbing was operating properly so that treasuries function properly here and around the world around that week that ended with March 23rd, and that when we saw a lot of the pricing dislocations in the debt markets. Treasuries have been that most, along with cash, have been the best safe haven, but we think gold continues to be a good safe haven, even though there's been that relative volatility, some of it because of margin buying, sell what you can, not what you want to sell. We know there was a lot of that going on, but when we look at what is going on around the world with central banks, where now in the U.S. we had a $700 billion QE program that is now open-ended, what we call QE infinity. That was followed on with the ECB with their 750 euro QE program that has gone to essentially open-ended and QE infinity. Massive stimulus by the PBOC. We now have the fiscal stimulus packages coming. All this points to an environment that is very good for gold from a secular argument standpoint. The feared trade that we think is still upon us, that we will have more of, points to gold as being a good safe haven, and we think a good investment going forward.
David, I want to ask you about, what value, I guess, guidance or end-of-year targeting still has in this uncertain environment, right? We've got this graphic that shows about 9% of S&P 500 companies have pulled their earnings guidance thus far. That doesn't count the ones that, of course, have just suspended guidance. And, of course, if you take a look at sectors, it's unsurprising that it's consumer discretionary that's hit the hardest. At the same time, though, Wall Street is pretty reluctant to drop its forecasting, and in fact, on consensus, they're expecting about a 14% rally by year end. How much credibility, and weight do we assign to forecasting, given that more and more companies are not even giving guidance?
Yeah, I think it's become very difficult for them. We came into, or we were looking forward to 2020 as finally being the year that we were going to return to profits for companies, in many countries around the world, and certainly for the S&P 500. Originally, if we go back to December 31st, we were looking forward to 4.5% growth in first quarter earnings for the S&P 500. That was consensus estimates. Now we're down to 7.3% earnings contraction, or negative earnings growth. So that earnings trough that we went through in 2019 that we expected finally to earnings growth because of coronavirus and its impacts has now turned into more earnings growth contraction, negative earnings growth going into this year. And, that negative number just keeps getting larger, and it will probably continue to grow here for the coming couple of quarters. And I think it is very difficult for them to forecast at this time. It's because of these unknowns, and until there's more certainty on how long this will last, what it looks like on the other side of coronavirus, when the consumer and how the consumer re-engages the economy, how we stage workers back into the economy. There's just a lot of unknowns. It's the first time that the world and the U.S. has gone through this, so it's very difficult for them to forecast at this point in time.
Yeah, and being such an exogenous shock, really hard to compare to lessons of 2008 too, right? David, very quickly, do you still like tech? Because as we see, FANGs were kind of the slowest to fall and the quickest to recover. Do you expect that resilience to be maintained?
Yeah, we do. We think, there was such a concern about the FANG stocks that big cap tech were a house of cards ready to fall. And what we've seen is really the secular growth story that we've talked about has stayed there, and that's really what has been resilient through this bear market, and we think it continues to be on the other side. So we like tech stocks because of the secular growth story. Cyclical stocks get hurt in an economic downturn, got hurt in this bear market. So yes, we definitely still like technology, information technology, and the internet.
David Kudla, thank you very much for joining us, founder, CEO, and chief investment strategist of Mainstay Capital Management.